Welcome back to the stream. Let's see what's going on here today. My name is Moji. Welcome back, traders. We are definitely, let's just get this up. There you go. All right, yep. So we're definitely on the stream. Hello, everybody. Welcome back. We have FOMC happening today. Let's update you on what happened since we left. You can see this huge. So on the left, on the right here, this is my 15-minute game plan channel. You can see this is a TPO candle in here with the 4-hour forecaster, and on the right is the trigger uh, chart as always. So we can see everything is pointing bearish right now. We are considered cheap. TPOs are red, and you can see as soon as we logged off, we had this huge drop. That was the short that I was looking for. However, it happened after I got off, but it doesn't matter because I didn't lose any money, didn't make any money, and we're here to see what happens when the news finally drops. So this is a good opportunity to see what these indicators can actually do for you. We have about 3 minutes until that drops. If you have any questions, please drop them in the chat. I'll be sure to answer them for you. Let me just go over real quick anything I see on my other analysis charts here. So right now, we're still inside the range, but we're looking like we're trying to break out the bottom. That's what we're looking at. We're still in the range on the daily, and on the IVD, we still have 3 bearish statements going on. So let's see if the bearish statements still roll. All right, here we go. We have about 2 minutes until the news drops. The ATR is at 13 right now. Let's see how much it spikes up. Hello, everybody. Welcome. Don't forget to drop a like. Thank you so much. Thank you for everybody who voted in the poll today. Thank you for everybody joining. Drop a like, drop a question on anything. I'm here to answer them for you. Let's see. Let me know if you want me to demo my funded futures trade during FOMC. Let me know in the chat. So are we bullish or bearish with this news? What do you think? What are we thinking here? We have about 1 minute till it drops. And here we go. In about 5 seconds. 4, 3. And let them go. Let's see which way we want to go. TPOs turned off. They went back to yellow. Now they're in red. You see the ATR jumping up to about 17 at the moment. We had a buy signal. We have a new 4-hour as well. New context. That was a huge spike. This is a long trigger. Let's see if it's gonna stay or if it's gonna reverse on us. So far, that's a long trigger right here. Boom, boom. Yes, that was a huge wick. So just be careful with that. Right now, algos are still red. IVD has turned off. I have a trade of 8 Dom open off screen just to see how crazy it's moving. Yeah, it's bouncing up and down. This is really good volatility happening here. It's not the highest I've ever seen. Right now, we're climbing up to 18. Let's see if we could. Let me get to my Top Step X dashboard so I can see the news. All right, so it's out now. Right now. All right, let's see what this says so far. So far, TPOs are red, so that's a bearish sign still. All right, so the report says economic activity has continued to expand at a solid pace despite swings in net. That's negative news. Exports affecting data. Committee judge risk of higher unemployment and higher inflation has risen. Interest rates actual is 4.5. The forecast was 4.5, so they stayed the same. The committee will continue to reduce holdings of treasuries and by MSB at current pace. Fed vote in favor of policy was unanimous. Short-term U.S. interest rates, futures, slight pair early, losing Fed shares and policy. Okay, so we got some negative news coming out from it. All this you can find on the Top Step X platform. I really like it. It drops it in live here. Now let's see what this does to the market. So far we had the red to blue. We had a giant spike. We have a Gabby button here. Right now this 4 hour is really not going anywhere. So that's kind of disappointing. Let's give it about 15 minutes. I treat it like an open. Don't forget Powell speaks at traders continue to see Fed rate cuts likely by July. Interest rate decision was 4.5, so that was neutral. Then at 2:30 we have the press conference. Yep, so right now has anybody seen a setup that they like? I have not. This was a long here. You could have taken a long here, but it's very risky because the 30-second money zone is bearish and the algo candles are bearish. So I would look for price to come down. You can see it here on the 15-minute. But really, this is my low a day right here, this purple line. Let's see if it breaks through it or not. Was trading, so let's look at the dashboard. In order for short, bearish, pullback, yeah, so I can see it shooting up before coming back down again. All right, let's see what happens here. So far it's been a bunch of nothing really. Don't forget to drop a like. All of you watching right now, if you're on mobile, if you're on your desktop, just drop a like real quick on this video. Here we go. There we go. You can see how quickly this changed over. We touched the expensive box and we came right down. TPOs are still red, so there's no longs at this time. Just move this over here. Remember this. Hello everybody. Don't forget to drop a like. Drop a like on the video. Let's see. You're looking at the TWA indicators right now. They're doing a great job. Look at the 4-hour forecaster on this screen. If you were looking short, this is what you wanted to see. Right in the expensive box, and down it goes. Down it goes. It's perfect time to ask any questions. Ooh, we are dropping. There we go. Let's see if we get. Where are we at? Yep, we're going after. Let's see. Yep. Let's go. Let's see what happens here. Anybody in this short, let me know. I am trading a My Funded Futures account on this. I'm in short on it. I'm not trading Top Step on this. I'm just My Funded Futures. Because why not, right? Let's all have a little fun. Let's have a little fun right now. Okay, let's see what we got. There you go. It's good. I'll take a little $600 day on this combine. That ain't too bad. Let me just move this over. So you can see how nicely the algo candles have really helped with direction today. You got the TPO helping with direction today. Price is considered cheap here, but it looks like we're still going to be heading down. Look at that, that's a straight shot down. Woo, look at that. All right, so let's just recap what was a good setup for this short. Now remember the ATR was climbing. So if you're looking at context wise, this was a good area to take your short in. You look at the surge that told you there, and even though the pullback indicator went first, it's kind of good confirmation, and then you've been going down ever since. I would not enter anything. I would not enter anything down here because this is just like, this is considered. Let me write it on this one. This is considered extremely cheap in this area, right? So you don't want to enter a short here. What you would want to see is it maybe price, pushing back up, stalling out, and then coming down. That's how I use these indicators to read for context and entries. All right, anybody here trading the news? I just dropped a little poll. Let me know if you're trading the news, yes or no. Let's go. All right, let's see what's happening over here. Look at this. All right. I might want to try and let me try to do this. All right, so at 2:30, I'm actually going to play the news conference on the live. So this way you can see it on the live. Let Let me just set it up now. So you can see how nicely the TPO and the trigger chart here. All right, this is the beginning of the pullback if you're looking short. Right here. Pullback, long, however you look at the market. All right, let me get this ready for 2:30. Let's see what we have going on. We're still dropping, so do this. Let's see. All right, you see how we're kind of getting stuck underneath that gray cheap box? That's actually a very bearish sign. Let's see if that continues. All right, there we go. So we're going to be ready for the news conference at 2:30. This is in about 15 minutes. Leave that up. How many people we got on there? All right. All right, so you can still see how nicely the TPOs have really called out this long, how nicely the 4-hour forecaster gave you an area to enter. The pinpoint, it happened, remember the ATR grew, so the pinpoint happened, went from green to red. However, if you also look at volume, right, if you like confirmations like I do, you can see how the surge and the pullback indicator, those two with the yellow circles on it, gave you a good opportunity to enter. Remember, going back to the earlier live, I've been calling for shorts since the open. Didn't see any opportunities between 9:30 and 10:30. One did happen right after, where we had a nice sell button. If you look at it here, where was it? That was one of them. That was one that happened. That was the first one. And this one, if you were in here, you probably could have taken the shorts all day. It's taken that one. Look at how nicely the Gabby button called it. There's a sell. And if you would have kept your stop above the previous 4-hour close, you could still be in this getting a massive amount of points. Here you go. A long opportunity failed. And now we're going to head lower. We have a new 15-minute candle starting with the TPO. And we are still red. Let's see. Here we go. We're heading down even further So far, everything is just like what we called in the morning for shorts. See if it continues through. I should have it to be perfect. Let's see. You can see. Wait, let me see now. Very nice. All right, I'm gonna post these results later today, but I did trade on a my funded account, the news, and let me see if I could show you. Let me push this up. All right, so you could see on the top here. Let me see if you can see that or not. Let me just go to this screen so you could see. Reports. There we go. Just trading using the TWA indicators and the analysis before. You can see the results there. Not bad for a couple minutes. Again, this is just using TWA indicators. Now let's see what happens at 2:30. So we're gonna watch that live. Keeping an eye on the charts. Let's see if we can get some. All right, there's 19 of us watching. Let's get some likes on here. Come on, let's push this up to 10 likes. Come on, everybody. This is a rare occasion. You get to see the TWA indicators at work during news, and you can see we just pointed out one cool setup for a short. You saw the results. I can make that into a little clip later so everybody can see it. Let me know if you're still looking, if you're looking long, if you're looking short. You like the fact that it's kind of stopping here. All right. Okay, there you go. This is a good setup for a long. So this is good context and good setup for a long here. However, everything is still red, so just be careful. Just be careful. This may be a good pullback situation too, because you see up here it says price action pullback with trend. The trend is right now short, so this might be it. Remember, it's probability, so anything could change. Let's see what's happening here. All right, so I'm gonna leave this on the screen. I'll be right back. Okay, I'm back. We have about 7 minutes till. All right, we got 7 minutes until this starts. So you can see where the one good setup was right here. I'll go back in time so you can see at about no, sorry, excuse me. You had a sell button here at about 130. Would have been very nice. You had another opportunity here when that blue turned back to red. That's another opportunity in. This is when the news popped here, and this was another opportunity in for a short. Everything is saying short. We have the dashboard saying shorts. We have the TPOs still saying shorts, even if price is moving up. Now this has nothing to do with price action, it's more of probability. For our forecaster, we are cheap, so you would expect buyers to step in. You saw right here, this was a beautiful wick up to the expensive box, and it came right back down. That was the trade of that 15 minutes. ATR is you can handle this ATR at 18. I mean, who remembers the craziness of the 40, 50, 60? I think I saw 100 ATR at one time. Things are just going nuts. The 18 doesn't feel like anything. So it's really good to have a pinpoint trigger system to really help you figure out when to enter if that's your issue. If you like probability, we've got a tool for that too. If you like reading volume, we have tools for that too. Let's go. Welcome everybody. Welcome traders. And you can see on the bigger time frame. So my trigger chart is on the 30-second. My game plan is on a 15-minute, and you can see how nicely the shorts we called out that were under my game plan, under the 20,000, played out very well today. I know I couldn't take advantage of it, but you know what? It happens. During the morning, during the challenge. So on the challenge, I couldn't. Right now, I did take a short on my funded. So I like trading prop firms. I use the same rules across all of them, and when I trade with them, it's all the same. It's basically, I have $2,000 in an account. How would I trade it? If I'm more aggressive, I have brackets for being more aggressive. I have brackets for being conservative. See, price is still climbing right now. Let's get this. Come on, guys. All right, so I'm just seeing if price can stay under 800, and that's basically under this previous 4-hour close. If we can, we might get another opportunity to go back in short. Right now, you see the longs are their bulls are trying to push price. ATR did go down a bit, so that's good for the bulls. Don't forget to drop those likes, please. Drop those likes. See, we have a gappy buy signal there. So, price is considered cheap. I mean, I wouldn't buy it, because my plan is calling for short right now. But see these algo candles at the bottom of the screen here? Let's see if those change. Let's see what happened in the news. You can see it live up there. Statements came in. Okay, no, haven't missed nothing yet. So okay, this is pretty nerve-wracking for me. Not because it's FOMC or anything, because it's very close to kids' dismissal time. So, we gotta have a clean break by 3 o'clock. But there was an opportunity. There's definitely an opportunity for short. I think this might be another opportunity coming up. Let's see what 2:30 brings. We got 1 minute till it starts. Okay. All right, here we go. Let's see. All right, so here comes the press conference. I'm going to pause the music. Okay, so far nobody's talking yet. Let me pause this. Okay.
Remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment.
All right, so while he's talking, I'll just do a quick. Right now, I see what was in a range on the daily is heading towards bearish on 2 daily charts. IVD is still red, background still red, TPOs are still red.
Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension.
Keep an eye on the money zone, the trigger chart.
How far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and
All right,
stable
TPO's
prices.
just turned off. That's a very
We're
bullish
committed to
sign.
supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
If you notice, the algo candles turned green while he was doing his speech.
CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say
All right, that's
which
a
way
short trigger.
this will shake out. I think there's
Right
a great
there.
deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, And I can't really give you a time frame on that.
TPOs are yellow.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, I mean, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times, but the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now, and we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated.
You can see, there you go. That was your cue. For a short entry, let's see if it plays out.
Goals are intentions. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So again, difficult judgment to make, and not one that we face today, and we may never face it, but we have to be keeping it in our thinking now.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more.
There's the short.
How
There
this
was a
is
short
going to
call.
settle out, and what the economic implications are for employment, for inflation. I couldn't.
Here's the short right there.
That I know what the
Here we
appropriate
go.
path will be.
So following on that, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do
Beautiful
the same thing,
pullback
which is
to a short.
We're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Oh, look at this dump.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there, and I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour, but the Beige Book was talking about the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet, and we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's you know, it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again?
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this.
All right, let's
we
see.
did things
What's
essentially
going on
around
here? We
emergency
had,
footing
let me
for
just
a couple of years in the pandemic.
get that for a second. So you can see we had a short setup here. We had a nice long setup before. Right now, looks like the bulls are stepping in this cheap area. Let's see if they can hold it.
Better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we of course tapered and everything. And then we immediately went into QT, and you know we're down a couple of trillion. But I get you know we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. You know, it's you know, we knew doing this in real time that we weren't going to get it perfect, and those kind of you know, after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that you know we
Nice
take
Gabby button
taking
for a
climate
long
as
there on the
something
cheap
that we're
box.
spending a lot of
If you
time
want
and
to take
energy
it.
on. We're not. We have very, very narrow things. We did one thing of one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And you know, we dropped out of the network for bringing the financial system. So we didn't do much on climate, but and I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And you know, the risk is if you go.
This is an area where buyers should be stepping in.
Then why are you independent?
Let's see if they can win.
You know, I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. You know, what we said was that we
Okay,
never
TPOs are
targeted
turning yellow here in this
unemployment
area
based
around
on
the,
individual, racial, or demographic.
I'll say,
So what we said was
1950s.
that maximum employment was a broad and inclusive goal, and I think what we meant by that was
So just beware, you're going to be in some chop here.
of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, you know, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how, you know, maybe people found that confusing, and you know, we have to take that into consideration.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses, big and small, are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, you know, so we really don't see in the data yet big economic effects. We see.
Look at how nice the Gabby button played out for a long
that higher prices may be coming.
match with
things like that. So
this
they're
and this,
worried
and
now
then this
about
start to
inflation.
change.
They're worried about
It's a good long if you took it.
You know, a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so you know we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time.
This
And
could be a
we're-
technical
and by
short
the way, our
setup.
policy's in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So.
But just be
we're
careful
feeling,
because this is
stress
yellow.
and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. You know, people are not getting laid off at high levels. You know, initial claims for unemployment are not increasing, you know, in any kind of impressive way. So the economy itself is still, you know, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, you know, what kind of interest rate decisions you will make later this year. So does that, you know, in March, there was guidance that
there
two
we
cuts
go.
might happen. You know, 2 cuts were penciled in for this year. Is that now
New 15-minute
from the last press conference? Has that been overtaken by events at this point?
You know, we don't do
ATR's picking up.
summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we did.
TPO's gray. Let's see which way wants to push.
Kind of poll people, so I really wouldn't want to try to make a specific
Let me see this.
projection for where we are relative to that. We will, in 6 weeks, we have the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be.
Yeah, there's.
Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending
I'm seeing a
on the way things
potential
play out, that could include rate hikes.
probability of a.
You know, it could include us holding
Let's
where
see.
we are. We just are going to.
If 19900, if it stalls out there, I can see a good short probability happening.
Great, and just to follow
And if
up
we
on
break
that,
it
when you
and
address
then
the, issue
retest
of
and
how
can't
the
break it
Fed
again, I think the
handled
long's going to
rising
take
unemployment and rising
the
inflation,
afternoon.
How are you thinking about the fact that addressing one could exacerbate the other? So a rate
You can
cut
see how.
to reduce unemployment could worsen
Let's just
inflation and
slow
vice
it.
versa. How does that? How
You can see how nicely the 4-hour forecaster really could have helped you out. This was a good opportunity for a short. Once it got into this box, it tried to get back out. It couldn't. That's a good opportunity for a long. Even if you, in this 15-minute candle, even you had a steep drop, it still wound up coming back. Right now, we're inside this expensive box. Price is trying to figure out which way it wants to go. Looks like it's stolen out here, but let's see. Let's see what price wants to do. All right, so we're gonna have about another 3 or 4 minutes left. I'll keep playing this, and then we'll end this power hour of a FOMC stream.
Judgment, but the data could break in a way that it's not. I just don't think we know that. The data
Please
is
drop
very
some likes.
favorable
Drop some
in
likes
favor.
if you like this
And right now, there's
this
no
meeting
way-
live.
No need
We could
to
do
make a
more.
choice and no real basis for doing so.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path. And it's on Congress to figure out how to get us back on a sustainable path. And it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement. And we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less, equally distant and equally or not distant, then we don't have to make that assessment.
Okay, that's a Gabby sell button. Let's see what happens.
I'm not going to try to be really specific about what we need to see in terms of a number, but if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire Jones, Financial Times. In terms of getting some clarity, we've...
Okay, so I need to stop the stream here because it's time to pick up the kids from school. But let's just go over real quick, what we saw during, what triggers we saw during this time period. We saw a short here. We had a great long trigger right here. And then another setup for a short that was a pullback short, came down a little bit. This is a bullish sign. You see how we're making higher lows. So, you know, we could see, really got to see what happens here. Who knows, they might say something that totally pushes it one way or the other. But this seems to be a sticking point. You could see how well the TPOs did as when they were red. Price was coming down from before. Then we had it started turning yellow here. So this is a very iffy spot to enter, which on the trigger chart is that short. So that's why you could have taken it, but you know, it was risky. And then this one now, we're in the expensive box. So you would just reduce contracts if you want to take a long. I wouldn't suggest it yet. I would like to see pull back to this money zone area before we enter anything. And as far as the analysis goes, I still see we're in a range. Two daily charts tell me we're in a range. I have a bearish statement, one bullish statement. So again, everything is mixed all over the place, as you kind of can see. It went right back into my low a day. So I think this is the area we're going to be playing in between, I would say between 20, right here, between these areas here. I think that's where you're going to see price go to. Remember, anything can happen from what they say. It could explode or not. Thank you so much for this special FOMC live trading session. I did take some demo trades on in a Mind from the Future eval. I showed the results before. I took the shorts because that's what I was looking for all day. And then we'll be back on again tomorrow at 9:20 for the regular New York session trading. Going back on to Top Step X to see if we can get some good trades for that day. Again, thank you so much, everybody. I have to go. If you have any questions or anything, just click on the link, fill out the Google form. You can find me on Discord. And if you want any information on any of the tools you see here, click the link, fill out the form, and I'll get right on it and get right back to you and see if we can get you set up with your own setup. Till then, thank you, everybody, and I'll see everybody tomorrow morning. Thanks.